Okay, ladies and gentlemen, we are on to our next interview in this series where I've been catching up with a stack of microcap fund managers, and this time I'm delighted to welcome back from H&G High Conviction, Joe Constable. This is Joe's at least second time, possibly third time joining us for an interview. Joe, how are you?
Yeah, very well. Thanks, Mark. Great to be here. Appreciate you having me. It is indeed the third time, and it's a pleasure to be back on with you.
Great. And yeah, myself and Joe caught up at Coffee Microcap Sydney the other day as well, which was great. And actually one of the stocks that presented at Coffee Microcap Sydney we're going to talk about a little later in the interview. But first, Joe, maybe just give us an overview of H&G High Conviction. It's this investment company for anybody who might not be aware. We're going to have Rob Miller from NEOS on actually in the coming weeks, another Microcap LIC. But maybe just talk to the H&G one.
Thanks, Mark. So H&G High Conviction Limited, as you mentioned, ticker is HCF. We are a pure play microcap LIC. So we see ourselves as having a niche position in the listed investment company sector. As the only investment company that purely focuses on microcaps. So we define that as sub 300 mil, but our real sweet spot's 50 to 100, sometimes sub 50 as well. So we really love this space. So we love the work you do. There's so many uncovered gems, and increasingly it's a part of the market that institutions aren't too focused on. And one of the fantastic things about being a listed investment company is that we have a structure where there's permanent capital, and it's perfect for investing in microcaps, where you have to have, I think, a 3-year plus investment horizon. And that's what we have when we invest in a company. And there'll be a lot of volatility often in those companies, but if you buy well and you're willing to hold through an extended period, we believe you can make very strong outperformance. So that's why we exist. We actually listed in October last year. We were a unit trust since 2007, so we have a long history of performing and outperforming the markets. But when I last chatted with you, we were just about to float. So that was October last year. And we've enjoyed our first year as a listed investment company.
And sectors, Joe, do you look like right across everything, resources, industrials, financial services, and is it just then picking the opportunities out of that, or is there kind of any sectors you generally don't tend to play around in?
Yeah, we go across all sectors, and the thing we really focus on is where can we see real value. So a company that is trading at what we believe to be a significant discount to its inherent value, and where we can buy at that really good price, and we feel like there are a certain set of catalysts that are taking place over the next few years, which will bridge the gap between that discount and the inherent value. There are so many value traps out there, and in the microcap space, it's littered with lifestyle companies and companies where the people who are running it aren't really focused on shareholders. There's always going to be a tug of war between the interested stakeholders, but we look for companies where it's very shareholder focused and it's about how do we make returns for shareholders. And those are very few and far between, which is why we have a concentrated portfolio of about 15 companies at any time. We feel like we know them better than most, and it's enough to be across and to really feel like, yeah, those are the companies that are really focused on shareholder value and are on a journey for the next few years to realize some real upside and real value.
Yeah, great. Well, let's get into it without delay. The first one I'm going to talk about is Centrepoint Alliance. The ticker code is CAF. For anybody, it's been a business, been around for many years. For anybody maybe who's not familiar with it, and it's kind of gone through a few different incarnations, spun off things and bought different things over its life. Maybe just give an overview of kind of the business today if we look ahead.
Yeah, happy to do that. And I'll just preface that by saying I did speak about this company last time I was with you in October last year, and I thought it would be good to refresh that. It's been a decent performer. It's done about 17% since then, mostly out of its dividends, including franking credits. And that's been a good outperformance, about 20% above the small ords. and we think there's a lot further to go. So what it does is it's a financial planning business, and it generates most of its revenue by providing licensed services to about 1,300 financial advisors in Australia. So most of their revenue comes from charging a fixed fee per advisor in the case of licensee businesses, and they charge a fixed fee per firm in the case of self-licensed businesses. And so they offer a range of services for that, and it's really quite sticky revenue. It's not based on how much business is written, mostly in these practices, but it's a fee for service. It also, on top of that, has about 19 financial planners in part of it as a group, and it shares in the profits of those advice businesses. And there are also some add-ons in terms of revenue, like mortgage broking that it offers in-house, and portfolio administration services and some asset management. But that's really the cherry on top, and those are the places where there's really good upside. The total pool of advisors that Centrepoint touches is they service about 150,000 clients, and that represents about $65 billion in funds under advice and $1 billion in insurance premiums. So it really is a meaningful business. It's about in fact, it is the third biggest advisor group in Australia. So it's a meaningful business, and it generates quite solid, sticky revenue.
And yeah, as you say, it's been a kind of a year, and it's done well over the last year. If we take your kind of 3-year holding period, we'll say you're one into the three, or somewhere in that continuum. In terms of the catalysts, or the reasons behind why you're kind of in here holding Centrepoint Alliance, maybe just run over those again, or has anything changed since we last spoke? I'll put a link in the show notes below to your last interview on CAF. But has the theory and the investment thesis kind of moved on over the last year, and some of the things you're expecting kind of come to fruition, with kind of more to come?
Yeah, the theory is gradually evolved, and more things come to light. But the key part of it is it's a really good valuation. There's what we believe very asymmetric opportunity, where you're buying at a really low valuation base. It's around 5 times EV to EBIT. That's true EBIT cash flow, and a dividend yield of over 15%, including franking credits. And it really makes it one of the cheapest companies on the ASX. And it's got a really strong balance sheet. It's about $15 million in net cash as at 30th of June, which actually covers about a third of its market cap. So we're value hunters. So that's the thing we like first and foremost. And you might look at that kind of valuation and say, well, the market is implying there's some kind of serious strife. But we actually think it's in a really good position, and it's proven that over the last year. And it's actually come out with guidance recently to say that earnings are going to be in line and possibly better than last year. And that's what gives it that 5 times EV EBIT. So our thesis has gradually evolved. It's become cheaper as its earnings has grown a bit. And so far, the capital growth has been very minimal. And as they say, in share price, most of the values come through dividends, which they continue to pay because they have fantastic cash flow. They're also one of only 2 advice groups in the top 10 largest financial planning groups in Australia that's actually increased advisors over the last 2 years. So the company hasn't been going backwards like a lot of groups in the space have, but I think they've been caught up a bit in a complete flight from investors outside of this, out of this industry, because you had the Royal Commission into financial services, and I think most investors said it's all too difficult, they don't want to be part of it. But Centrepoint's proven that they can be profitable and actually come out a stronger business, because they're getting much more sustainable revenue, because it's a lot more fixed. The other thing that we really like, and this is coming even more value now, is there's really material upside on its 5 times EBIT, which is hard to believe, because that's implied that there's no growth ahead. But it's yet to really tap that $65 billion of funds under advice that it touches. And historically, it's only just provided services to these advisors. But last year, it began this mortgage broking lending as a service platform. And from early next year, it's going to start providing model portfolio solutions, and at a really cheap rate. So there's very good potential for them to distribute this because they have all these advisors that they have a touch point with. And the other thing that I really believe is, and this is a big, continue to change since we chatted last year, is this whole financial advice industry has gone from being uninvestable and people just wanting to get out because of that whole shakeup and uncertainty in the Royal Commission, to actually becoming quite a hot sector and one that is people are starting to gradually dip their toes back into. And in fact, Centrepoint Alliance did have a takeover bid for the company. A competitor tried to acquire it last year, actually at a 40% premium to the current share price. But Centrepoint believed that actually undervalued it. That was at 32.5 cents a share. And we're seeing it in some other listed competitors, more M&A activity taking place. So Diverger recently has been the subject of 2 competing takeover bids. And we think that there's more to come. And Centrepoint's in a great position to either be acquired, but we really like it as a vehicle to acquire other businesses. And in fact, last week, they announced they have acquired a smaller financial practice. So we think it's a really good, exciting position. The market has still got that baggage, and so I think that's why it's got that low valuation. But the green shoots are there that the industry's got past the worst. Advisor numbers are no longer declining rapidly. There's a bit more certainty around regulation, and there's talk that for the first time there's actually growth in profits in the financial advice space as a whole, and that's after some years of decline. So that pivot is beginning, but I don't think the market's really put up to that, at least, especially in the Centrepoint stock.
Yeah. I mean, you talk about risks there, and you mentioned the Royal Commission a few times. I mean, we were talking just before we started about, I don't know as a risk to financial services anymore. We've had so many of these changes over the last decade, from FOFA to the Royal Commission to now the Minister Levy's review. It's just that doesn't apply to financial advice, right across financial services, super. I mean, you'd need I don't know how many CPD points you'd need to keep up with all the changes that happen in super from year to year. But in terms of risks for the business, obviously regulatory, I think we can just say is like a stock standard risk, because it's, it just seems to be constantly changes, and swings in government policy seems to happen all the time. Doesn't matter, which party is in power, they seem to change their kind of position on it. But in terms of kind of risks for the business, what are kind of some of the key ones if we just assume regulatory is one? What would kind of be some of the others that you would see?
Yeah, let me first just expand more on the regulatory side, if that's all right, because I think you're spot on. That is key part in it, and I think it's more uncertainty than anything else, and we're still, the government has started to propose some of those reforms that the Levy review put forward, but not all of them, and it's still yet to be fully implemented and finalized, and so there's still some uncertainty around that. What gives us some comfort, or quite a bit of comfort in fact, is that Centrepoint is in a pretty de-risked position within this sector. So a lot of the regulation has become all concerning the conflicts that were apparent in the financial space. So when you had fully integrated banks and asset managers and advice businesses, and of course they were just pushing their own products through the advice business. So they weren't looking to make so much money from the advice business in and of itself, but it was about the rebates that they got back from recommending financial products. So Centrepoint completely pivoted its business, and that was about 3 years ago. It was doing that before, but it's now, as I say, the absolute bulk of its revenue is coming from fees that it charges advisors for the services it gives them, and those are licenses or compliance, everything that you need to become an advisor. And now that advisors have moved from these big firms to much smaller ones, you might have just a few advisors in a practice, they need to use the likes of Centrepoint for that. So Centrepoint's actually providing them a regulatory kind of crutch, I suppose. So they're in a pretty good position in that respect, and there's not too many conflicts around for them. Yet there's always the risk that things change again, and it just makes the whole industry unprofitable again. So that's always there. But we think that there's a bit of a corner turn. The government knows that advice has to be a profitable business. It's a crucial thing for Australians, and to see this outflow of financial advice has been really deleterious for Australia. And I think there's a much more focus now on how do we make it a regulated but profitable and sustainable industry. And so we've seen some green shoots there, which gives us some hope. The other key risk, and it's for any business, is management execution. And they are embarking upon a strategy. As I mentioned last week, they made their first acquisition. They're embarking upon a strategy of growth through acquisition, and it's a fantastic time for that because you've had this massive shakeup and a lot of smaller businesses now, and Centrepoint's in a good position to pick them up with a really strong balance sheet. But of course, acquisitions are very difficult to integrate and execute really well. Management has had some success. They bought Clearview's financial advice business a couple of years ago and did really well. But of course, there's always a risk that it doesn't go to plan, and they can quite easily burn through some shareholder capital. So we feel like the board, we're pretty close to the board. We think they're really solid. So and so is the management, but it's always a risk.
And in terms of if I have you back on here in 12 months' time and you're giving us another update on Centrepoint Alliance, what are you kind of looking for the business over the next 12 months? Is it just these little bolt-on things to, add to their own group of advisors and kind of grow that and, pick up a few licensees? Or is kind of the main thing you're looking out for is how the launch of, the model portfolios and, these, I guess, emerging and potential revenue streams, how they kind of get received by, the end clients of the financial advisors that sit under the Centrepoint Alliance umbrella, whether that's their own advisors, their licensed advisors. Just maybe talk to us, if you're looking at, the half-year reports in February and next August, the full years and anything in between, what is kind of your key points you're kind of looking out for in terms of the commentary?
Yeah, well, I think the key thing is you really touch on the important point. So you're getting paid to see how they can execute on some of these upside potentials with, as I say, that 15% dividend yield. So that's what I'd really like to see in a year's time, as you say, is that you've been, first and foremost, you've been paid those dividends. The second thing where the upside can really come in is getting those portfolio solutions, individual managed accounts and software rolled out to a decent amount of advisors. And again, it's complete. Once you get them out, it just goes straight to the bottom line for Centrepoint. So that's some fantastic upside. And you've seen through some of those other providers like Hub24 just how successful they can be and how profitable those businesses are. So Centrepoint's in a fantastic position to do that at a very low cost to acquire, extremely low cost to acquire new business there. So that's something that I want to start really monitoring from early next year when it's going to be rolled out. There might be some key signs in the half yearly, but especially in the annual, we would like to see some figures there. Further M&A activity is definitely a thing, and I'd like to see not just some small bolt-ons, but there's the potential for some bigger acquisitions and to really step change Centrepoint to get it from, it's now about a $10 million EBITDA business after this most recent acquisition, to really get it up to 20 mil over the next year to two with some smart acquisitions. I think that would be a fantastic thing, and that's what I'll be looking out for.
Let's change tack a bit, and I say a bit because our next business, Kinatico, ticker code KYP, also in the kind of compliance space, so not too dissimilar from Centrepoint Alliance, but targeting a completely different market. But for people who weren't at the conference in Sydney where we had Michael Ivanchenko, the CEO, present, and indeed I'll put a link to Michael has presented at our Coffee Microcaps morning meeting webinars a few times, and I'll put a link to his most recent one in the show notes below. But for anyone who hasn't come across the business before, It used to be called CV Check. I might mention that. Maybe some people know it from its old name. I think it had a name change maybe a little over a year ago, somewhere around there. What does this business do?
Yeah, well, thanks for that intro. And I think you're right. One thing that we really like at H&G High Conviction is really boring businesses that can produce decent amounts of cash. And that's a theme in these two, is reg tech. That's the sector this is in, and there's no better, more boring sector. But this is a business that's really solving the very real need of ongoing people verification for large enterprises. And they began, as you said, in the very commoditized CV check space, where they were doing mostly criminal history checks for large enterprises. So say the Starbucks or someone who's just constantly employing people. They still actually are the biggest in Australia for that. They have about 10,000 customers or so. And that's the old business, but they've really pivoted that to make it a total solution for enterprises. So what they're really doing is removing the need for these enterprises to retain high security identification data, where in the past, and even still for a lot of businesses, it's just put into Microsoft Excel. And it's all the important information about do these employees have the right working checks, working with children's checks, the capacity to, on a mine site, use machinery, etc., and that all has to be logged. So this is a complete software solution for that. So 2/3 of revenue for the business is this more historical, the legacy part of the business, which does the criminal history checks for employees, and then the other third is a software as a service product called Cited, which, as I said, is this end-to-end workforce compliance and management software for enterprises. And KYP Kinatico has really found traction recently in the healthcare sector. And this is where, in particular, numerous organizations have so many employees and contractors constantly coming onto their books, and they need to ensure that all these staff have updated credentials. And one of their largest customers, in fact, is Aruma, which has about 6,000 employees that provide disability services. So they have a frequent need for screening employees, ensuring they have the right working checks, and it's essential when you're working in these kinds of healthcare businesses. Other major enterprise customers include Ausgrid, the Australian government, in particular the Department of Health and Aged Care, Chubb, and certain TAFEs around Australia as well. And that part of the business was only really started going about 2 years ago, and is what we believe the real driver going forward, and a very exciting opportunity.
As you say, it's kind of evolved its business from the early days of doing the pure CV check of, somebody new coming into into the business. This is kind of more evolved into, employees on a kind of more holistic approach. My brother's a tradie in Melbourne, and I just hear from him, I know not really related to Kinatico's business, but you've got so many subcontractors coming on. Have they got their kind of health and safety stuff in place, or have they got the licenses to operate the equipment that they're coming on? And the site managers, project managers, are checking this like all the time. And I guess it's the same if you're a business that, even in healthcare, where you've got nurses, physios, all of this coming in at various times, making sure that like all these people are kind of covered from a compliance point of view. You can see how it becomes a very big headache very quickly.
Yeah, 100%. You can imagine what a big market it is for them. And what I like about it is, we've all been touched by red tape and compliance, and it's a pain, but it's nice to make some money out of it at the same time. So that's what we're excited about. But in terms of the investment thesis and why we really like it is, it's easy to say it's a tech business with a big market, but this is actually fairly cheap on traditional valuation metrics. So it's an EV to EBITDA of about 6 times based on the last half's run rate. Second half, as I say, it's grew quite strongly, and an EV to revenue of about 1 time. So they're pretty cheap compared to a lot of other large addressable market tech companies. And the CEO at the moment is a guy called Michael Ivanchenko, and he joined the business in August 2021. Who presented at your conference a few weeks ago. And we think he's a really impressive leader. He's helped to reposition the business from that commoditized criminal history check business to a real genuine software business that's embedded in these large enterprises for annualized subscription revenue and very sticky, the kind of sticky contract where you have to do something seriously wrong to be kicked out from it. And they don't have any natural competitors at the moment. It's really just, as I say, Excel. It's these companies moving from doing it all in-house on Excel to outsourcing it to the software. That business, this software as a service subscription revenue, actually grew 212% in FY23 to about 8 million. So it's a decent size. And because of this, the gross profit margin of the whole company has increased substantially to 67% last financial year. And that's up from 59% in just 2 years ago. So it's really come quite a long way. And you're seeing the benefits of this much better subscription revenue. The other thing that is actually showing in the bottom line, which is always nice to see, and again, very rare with the tech company, but it just posted its first ever net profit after tax last year. It was a very modest $750,000, but in the second half, it was actually $1.5 million because it was a loss maker in the first half. And that's just showing those, as everyone says, the jaws opening, and they're really, now that their costs are pretty fixed, this extra revenue has fallen to the bottom line. So it's a fantastic time. It's a real pendulum moment for the company. And as I say, there aren't many tech software companies addressing a big market, growing, that are free cash flow positive, profitable, and on a fairly decent multiple. The final thing I'll say is, this is something we always look at closely, is its balance sheet. It's very strong. It's got cash of about 10 mil, and that accounts for a quarter of the company's market cap. So it's in a really solid position to keep growing.
And I know you took on risks, or you touched on it slightly there in terms of, they really got to mess up to kind of lose somebody. But maybe let's just touch on the risks and talking about losing customers from messing up. Anybody who's an Optus customer in the last few weeks who know like how critical it is if you're using it in a business sense. Optus is your provider for, EPOS point of sales, or like kind of running your whole kind of internal Wi-Fi, and now you suddenly can't open because you kind of don't, as a small business, maybe don't have a backup provider kind of on hand. And well, even Melbourne Trains didn't have a backup on hand, funnily enough, for a business you would think would have something like that covered. But I think maybe we can touch on that in terms of like, what are the risks kind of internally, and perhaps maybe if there's some kind of external ones I'm not thinking about here.
Yeah, you're spot on. That's the biggest risk, I think. I would say it's a cybersecurity risk in particular. They are taking that risk away from these companies by being the custodians of this data. So they need to, of course, always be one step ahead. So I've spoken to them at length about this. They put a lot of focus onto that, and ensuring that they're in the safest position possible. But of course, that is always a risk, and we've seen that come out more and more. So they need to keep on top of that, keep delivering, really top class customer satisfaction, and yeah, I think that's front of mind for them. And I think to their credit, they've really focused on not growing too quickly. I mean, and I talked about some pretty big growth numbers, but it's off a fairly low base, and they're being fairly conservative. They're still running a profitable business, so they're trying to grow sustainably. And I think sometimes when you do it just too fast, that's where you can overextend and open yourself up to those sorts of breaches or data security issues. So, but 100%, that's one. The other one, as always, as with Centrepoint, is management execution. Particularly in a growth phase, you have to be so spot on, and they're going to have to hire some more people as they grow. You need the leadership to be really, really tight. and they've cut costs quite a lot over the last few years as they've moved to a more automated business. Because as I said, it's less just about history checks, but more about software. So it's about, can they continue a positive culture in that context, and there's, the employee base is shifting, and that's all management. So we back Michael as a CEO, and we've actually met most of the executive team and some other employees. So we think he's done a good job at setting a good culture, but that's absolutely crucial for a business at this stage. And the other thing is that they, as I said, they have about $10 million in cash. It's a really decent amount. I'm sure it's burning a hole in the CEO's pocket. So it's about the discipline to use that wisely, and really pounce at the right opportunity if there's an acquisition out there, but not squander it. So there's always a risk in that. And to that end, we are quite close with the board. We actually proposed that one of our contacts go on that board, Georg Schimmel, and we're really pleased that he did. And we feel like him and the rest of the board are very sensible and focused in the right way, which can help mitigate that risk a bit, but that's always there.
And again, yeah, if we kind of look out the next 12 months, what are you kind of going to be looking from, Michael and the rest of the team there? Is it that kind of, you talked about the first half, second half split in the FY23 numbers. Are you kind of looking now for that, kind of sequential half on half improvement in the operating numbers, and just kind of, if there's a bolt-on acquisition to come in there or something larger, that's also potential for the next 12 months?
Yeah, I would like to see continued growth in the software as a service line. That's the key thing. The subscription revenue amongst enterprises will be the focus. I think earnings can I think they'll stay positive. I'm sure they'll fluctuate a bit as it's a growing business, but definitely stay profitable, still make decent EBITDA, but really show that they can continue to sustainably grow that SaaS revenue. And we'll find out more when they do a quarterly update, probably in January, I'd imagine. And I'd like to see that revenue grows a bit, especially as they've recently announced some good contract wins with the state government of Victoria and the Victorian Builders Association. So I'd like to see that in some of the numbers. But yeah, SaaS revenue is now, as I say, about a third of total revenue. It'd be fantastic to see that nearer to 50% somewhere in 2024. And I think that is going to continue to help re-rate the company as people see it's a really solid revenue base. And as you mentioned, continue that profitability and show a pathway to being a really meaningful earnings generator.
Okay. Joe, thank you very much. I think we'll leave it there. And yeah, if anybody wants to check out more on H&G High Conviction, as Joe said at the top of the show, the code is HCF, or Hotel Charlie Foxtrot, for anybody who wants to get it in the phonetic alphabet way of doing it. I mean, all the monthly NTAs, updates, annual reports, all the kind of stuff that you would normally associate with listed investment companies, you can get off the ASX announcements platform. Joe, thanks very much for joining us, as I said, once again. And yeah, we'll keep an eye on both CAF and Kinatico over the next 12 months. They sound interesting stories for kind of different reasons.
Thanks very much, Mark. Really appreciate your time, and thanks for having me.